Welcome back to AI Research. Today, we are diving into a visual history of the U.S. economy through the lens of the 10-year Treasury yield. This single line, sourced from the Federal Reserve Economic Data, FRED, tells the story of every major boom, bust, and recovery over the last 60 years. The big picture: 60 years of yields. The 10-year yield is a critical economic benchmark. It sets the baseline for mortgages, corporate loans, and serves as a primary indicator of investor confidence. Looking at the chart, we can identify three distinct eras. The Great Inflation, 1960s minus 1,981, a steady climb driven by rising inflation, peaking at over 15% when Fed Chair Paul Volcker hiked rates to stabilize the economy. The long secular decline, 1982 to 2020, a 40-year bond bull market, characterized by stabilizing global trade and aging demographics, bottoming out near 0.5% during the 2020 pandemic. The sharp reversal, 2022 present, a rapid, V-shaped move upward as the Fed fights post-pandemic inflation, ending the era of easy money. Recession causes and yield behavior. The gray vertical bars represent U.S. recessions. While yields typically drop during these periods as investors fly to safety, the triggers for these downturns vary. Era. Recession period. Primary causes: Vietnam era 1969-1970. Fiscal tightening, war debt and Fed rate hikes to curb early inflation. Oil shocks 1973 to 1975. Energy crisis. The 1973 oil embargo led to stagflation, high prices plus low growth. Volcker era 1980 to 1982. Monetary shock. The Fed intentionally crashed the economy to break hyperinflation. Gulf War 1990-1991. Oil spike, Iraq's invasion of Kuwait and a slowdown in consumer spending. Dot-com bust. 2001. Asset bubble, the collapse of speculative internet stocks and tech investment. Global financial crisis. 2007 to 2009. Housing collapse. The subprime mortgage crisis triggered a global banking failure. COVID-19. 2020. Exogenous shock. Global lockdowns halted economic activity overnight. Key takeaways for investors. Understanding this chart is essential for building a resilient portfolio. Here are the three most critical lessons. The flight to quality. During almost every gray bar, you see yields drop. This confirms that government bonds remain the primary hedge against stock market crashes. When stocks tank, investors buy bonds, driving yields down. Yields are gravity for stocks. When the 10-year yield rises sharply, as seen in 2022 to 2024, it makes future earnings less valuable. This is why high-growth tech stocks often struggle when this line is moving up. A new regime. The 40-year downward trend has officially broken. We are no longer in a low-for-long environment. Investors must now shift focus toward companies with strong cash flow and pricing power that can thrive even when borrowing isn't cheap. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.